So I'm going to go over a policy that I set up for a client about 6 years ago. He started in 2019. He had a plan to pay in about $600,000, and he's actually paid more money into the product. And the main reason why is because he's liked the performance. So what we're going to look at is what the original illustration showed in terms of the actual cash value growth, and then what has actually happened. And if you have a whole life insurance policy, I'll go through exactly what to look at so you can track the performance of your policy. And if you're thinking about getting one, this hopefully will be valuable too. This way you can learn exactly how to track the actual performance of your policy, which can be harder than you might think because annual statements and the information insurance companies provide are not always that transparent. So his situation, he was and still is a mortgage broker. He does very well. When we first met, he had a ton of cash in the bank. He learned about whole life insurance. He wasn't really that interested in the death benefit, but he was interested in the cash value. Why he was interested in the cash value was because he viewed it as a safe place to put money. It was liquid in the sense that he could access it anytime, specifically through policy loans. And then third, it's tax-free as long as we, the agents, do everything right when we set it up and then manage the policy over time. Now, about his situation, we had a number of conversations and he was really nervous about committing to a big bill because as a mortgage broker, he's in sales, his income can fluctuate. And his income had always been healthy. It was north of $500,000 per year. He still does very well. So he could pay a big premium. And it was one of those situations where we could look at it, meaning look at the history of his income and say, you can do this. But at the same time, there was an emotional side of things where he said, it's just going to stress me out because I don't know what's going to happen in the future. In my industry, if there's a big market correction and interest rates fluctuate, that can really impact my income and the amount of volume of people I have to talk to. So committing to a big bill was going to stress him out, and you'll see exactly what I'm talking about here in a moment. So the original plan that he went with was to be able to fund a policy with $120,000 per year for 5 years, which is a total of $600,000. Let's take a look at the illustration. The one thing I want to hit on is you're going to see $120K per year going in, but that is not what he was committed to by any means. So when we look at the illustration, we see that his policy was with one of the 4 major mutual companies, Guardian. He started at 41 years old. He received the top health class rating. We see guaranteed values on the left, and then the non-guaranteed values based on the current dividend rate in the center. This is what we want to look at because this is what he was counting on, and this is also what we look at when we track the actual performance of a policy. So the first year, the plan was to deposit 120, and the illustrated cash value was 105 and change. The worst year is always the first year. At the end of the 5th year, the illustrated cash value was $626,000 and change. Now, when we look at this illustration, I said this policy was started in 2019. This is the illustration from 2019. His policy date is February of every year. So this is back when he started, back in 2019, which is pretty cool when we can compare the original with what actually happened. So if you're taking note of the illustration, I would look at a couple things here. First year cash value, did that actually happen? The 5th year cash value, did that actually happen? And then what we're going to look at are these dollar figures, but we'll put them on Excel and we'll look at the returns as well, so we can see what the net return was every year, which will be nice. So that was his original plan. We're going to compare that with what he actually did. So here's how we compare. What we want to look at year over year are the annual statements. This will show exactly what his cash value is at the end of each policy year. What we also want to pull is the transaction history. This way we can see exactly what he paid in each year and see if it matches the original plan or if he paid in a different amount, because he's got a lot of flexibility. If we go back to that illustration, remember that point I mentioned where he didn't want to be committed to $120,000? Here's his minimum premium, $12,000, meaning he can literally pay just that, and then everything else that goes into what is called his paid up additions rider can be added at his discretion, which I'll talk a little bit more about this design later. But his minimum is about 12, and he's got the ability to add up to 120K per year. So just to hit on this point, when we look at the annual statements and actual performance, because he's got that flexibility and he's not required to pay in 120 per year, we want to see if he actually did, which he did. We have review calls every 6 months, so we're always tracking the policy performance. So let's take a look here at the annual statements. A Guardian's annual statements are nice, how they break these down. So as we look at this guy, there's the first year, 2020. So we started in 2019, and at the end of the first year, it's 2020, and the cash value was 105 and change. Let me make that a little bit bigger. There we go. End of the first year, 105 and change. Second year, 228. Third year, 354. He's been paying 120 per year. If we look at the next 3 years, there we go. Actually, we'll pick up with year 3. In 2022, there's that same 354, then 485, then 624. So we can see what actually happened year over year, which is nice. Okay, so to make this easier, let's take a look at this on Excel. We'll begin with what we just looked at, the original illustration that is, but on Excel. So first year, 105 and change. Year 5, 626 and change. If we go back to the original illustration, there it is, 626 and change. So everything we've got on Excel will match this Excel illustration dollar for dollar, because literally I just converted the PDF and threw it on Excel. Like, that's what we did. So back in 2019, the dividend interest rate was 5.85%. Notice that we've got the words gross in parentheses. The reason why is because the dividend rate is never what our money will actually grow by. That is a gross rate applied to our policy after the company's insurance expenses. What we want to look at is the net annual yield. This displays the net year-over-year return. First year's negative because he paid in 120. He has 105. There's the negative return in the first year, 12% hit. Second year is 1.37% because he was at 105. He paid 120. If you just add 120 to 105, that would be 225 and change. However, he's at 228 and change. That's why we have a positive return. And it gets stronger and stronger every year. In his particular case, he said, hey, returns are great and all, but I'd like to see it in dollars. So we've got the yearly growth. This way, if he asks, what did I get from the insurance company last year? This column will tell him that. This is not his dividend column, by the way, because the dividend does not represent the true number. It doesn't include the guaranteed interest. So for 2024, based on that original illustration, he would have received almost $25,000 from the insurance company based on what he had paid in. And then lastly, you've got the total gain, which is pretty simple. We just look at how much he paid in, what he has in cash value, and the difference is the gain. Make sense? Cool. So those annual statements we looked at before, there's 624 in 2024. All right, let's have some fun with this. So we started his policy in 2019. Year 1 on the annual statement showed 2020. I made it 2019 here because that's when he actually started his policy. So if you're looking at the annual statement dates and this date, 2019 on the Excel workbook is the 2020 date on the annual statement. You'll see the values match up. It's all accurate, I promise. So first year, what was illustrated, it hit dollar for dollar, which is fantastic. The next year, 2020, he paid the exact same dollar amount in, 228, 277. The original illustration was what? 228, 612, meaning his actual results are a little bit less. Why? Here's why. When he started the policy, the dividend rate was 5.85%. So that original illustration assumed that the dividend interest rate remain at 5.85% forever. However, in 2020, Guardian's dividend rate came down a little bit, came down to 5.65%. So as a result, he has a little bit less in cash value. That results in a little bit lower annual yield and a little bit less in cash value growth when we look at that. Now, as we look at it year over year, what do you notice? By the fifth year, 2023, it's pretty close. You're off by what? About $1,500, $1,600. And the growth rate in year 5, based on what actually happened, was a bit stronger than what was illustrated, which is nice. So that's through the 5th year. If we go back to our document, let's look at year 6, because he liked the performance so much that he added more money. And when I say he liked the performance so much, it's not that these returns here are just killer. He's not putting money into a life insurance policy just for the returns. He likes the idea of using this specifically for real estate and seeing that the growth is going to compound very close to 4.5% as time passes. That's appealing to him. Also, when you bundle that with the fact that it's tax-free, that creates the, okay, I like this because before I just had money sitting there in cash. Now I can put it here. The growth rate is more attractive. It's got a nice tax benefit. And then in addition to that, if I decide to leverage it for real estate, I keep earning that interest too. That's what he's attracted to. So he paid for 6 years instead of the original plan of 5 years. So he's pumped in now a total of $720,000. There's the cash value. Dividend rate came up again to 5.9%. And the returns look pretty good, don't they? Let's look at things moving forward, which is based on an in-force illustration, which again, I just dropped on Excel. But now the dividend rate has come up again. So this is going to pull the return up as time passes, and you can see it immediately. So 2025, which is the year he's about to enter, his policy year begins February of 2025. Dividend is 6.10%. The annual yield, 4.33%. All right. With the original illustration, with 0 going into the policy, 3.98%. So he's stronger now. There's 2 reasons why. The first is because the dividend's higher. That's going to result in a higher net yield in almost every case. But then 2, he's also pumped more money into it. If I pump a lot of money into a policy, especially up front for, in this case, six consecutive years, I am going to see a higher rate of return. So for example, if the dividend was the same with these 2 examples, and I fund one for 5 and one for 6 years, when I look at that 7th year, the example where I pumped money into it for 6 years will be a little bit stronger, like what we see here. However, they're both very close because both are optimized. The main reason this is a bit stronger is because of that higher dividend rate here. And then if the dividend does not change, there's the annual yield. Then he's got the same thing in terms of yearly growth. And then we've got the total gain here. Looks good overall. He's been very happy with the policy since he started it. And he recently took out a huge loan to finance a big property that he's been renovating, which he just renovated it, just put on the market. And his plan is to sell it for an amount that is more than, I think, 2.5 or 3x of what he put into it. But in the market he's in, he should sell. It's a beautiful property. So how do you get a policy like this where it actually works and I see strong cash value growth year over year? 2 main steps to follow. The first, make sure we look at one of the major mutual companies. That's what I would always recommend. The major mutual companies are Mass Mutual, Guardian, New York Life, and Northwestern Mutual. The simple reason why is that I've always seen them actually deliver. Personally, I don't have to worry about a situation of overpromising and under-delivering, which happens way too much in the life insurance industry. But that's the first thing I would look at. Second, this one's big, and it can be technical too, policy design. So when you put money into a policy, him, for instance, he put in how much? $120,000 per year. In his policy, the life insurance amount, the actual death benefit, was minimized in order to handle a payment of $120,000 per year without triggering what is called a modified endowment contract, or a MEC, which results in a taxable event. So we want to push the death benefit as low as we can to prevent a taxable event. And then when we look at that $120,000 going in, my question, if I'm you, would be, where's my money going? Because at the end of the day, it can go toward the premium or toward my paid up additions rider. Premium dollars I like to refer to as the initial insurance expense. The reason why is because when I look at it, premium dollars primarily get me a death benefit first and then eventually build cash value, whereas PUA dollars build cash value first, or I should say prioritize cash value first, and they do give me some death benefit as well. So to illustrate that, if we go back to his original illustration, here we go. Of that $120,000 he's paying in every year, here's the premium, $12,000 and change, and then here's your PUA rider. This reads scheduled. His was actually unscheduled. What that means is he added those additional funds when he wanted to. The company did not send him a bill for $120,000 per year, because if we go back to one of the points up top, that would have stressed him out. And he made that very clear when he started. He shopped multiple agents, multiple companies, and that flexibility was so important to him. So his actual commitment came out to a little bit more than 12. That minimum base premium was $12,000. But then we added another $1,200, which satisfied the cost of a term insurance rider. And then everything above that term cost went toward PUAs. Adding term is a cost-effective way to prevent a MEC from occurring. But basically, to simplify, he was billed for $13,200, and then everything above that, up to the total of $120,000, was added at his leisure. So, as we mentioned earlier, what he's looking to do is to sell a large investment property, and then once he has that cash, pays the capital gains tax. His plan is then to do the same thing for his wife and kids, meaning similar policies where they are all set up for maximum cash value, and just build that large bucket of cash, which he plans to continue to use as a line of credit as the years pass. So I hope you enjoyed this video. If you have any questions at all, please feel free to reach out anytime. You can leave a comment below. Let me know if you enjoyed this case study and if you'd like to see others like it. And as always, I hope this helps. Thanks so much.